In this class, we will conclude the discussion on Chapter 14, Internal Control and Audit, and our discussion will cover three topics. First, we will go through the meaning of internal audit and external auditing. Next, we will talk about the relationship between internal control and audit here. And by concluding this chapter, I will share with you how to ensure the effectiveness of internal financial procedures. So let's start to discuss about the internal auditing and external auditing. It's very important to differentiate between internal auditing and external auditing. The terms audit is more or less the same, but internal audit and external audit are different. For internal auditing, first of all, it is an internal or the activities performed within the company, and it is set up by the management team to examine and evaluate the organization's risk management processes and systems of controls, and to make recommendations for the achievement of company objectives. So basically, internal auditing is a set of procedures or activities by the internal management team, and the purpose of it is to examine the controls or the systems of controls and the processes. For systems of controls, we have discussed in the financial controls and financial systems and technology, including different cycles. For example, the purchase cycle, sales cycle, inventory cycle, cash cycle. And for those systems of control or the internal controls, we have to ensure they are effective. So who is responsible to monitor for those controls is by internal auditing. That is the internal auditor. And for external auditing, it is different in terms of saying that the purpose of external audit is to make sure the financial statements are fair enough for the readers to understand the business. So it is the independent examination of the evidence from which the financial statements are derived for each transaction. For example, whether they are well supported by evidence. And the purpose of external auditing is to give the reader of those statements confidence as to the truth and fairness of the state of affairs which they disclose. So in other words, external auditing, first of all, is performed by the external auditor. They are an independent examination on financial transactions. So the financial statements published can be a solid statement for the readers to read through it with confidence. And another key word here for external auditing is truth and fairness. So in other words, the financial statements should give a true and fair view of the state of the numbers or of the affairs. So here I would like to divide the differences between internal and external audit in 5 areas. First, role. Next, legal basis and scope of work, approach, and responsibility. So we will go through the differences between internal and external audit in these 5 aspects. First, the role. For internal auditing, it is to advise management on whether the organization has sound systems of internal controls to protect the organization against loss. As said, internal auditing is established by the management of a company to help them manage the company by reporting to the management team on the company's risk and systems of control. So internal auditing, the role is to advise the management whether the system is good or sound enough to protect the company or protect the organization. And for external auditing, it is to provide an opinion. So external auditing for the external auditor is to provide an opinion to the shareholders on whether the financial statements give a true and fair view. So for internal auditing, is for management. And if you can recall what we discussed in another class, the management sometimes is not the same as the shareholders. If they are separated into two groups, management will run the company and shareholders, they just appoint the management to run the company. So for external auditing, the opinion or the target audience of the opinion is the shareholders. So the external auditor provides an opinion to the shareholders on whether the financial statements give a true and fair view. And in many countries in the world, external audit is required by law or is legally required. So on next aspect, we'll discuss about the legal basis. As said, for external auditing is the legal requirements for large companies, for public companies, or to many public bodies to have the legal external auditing to ensure that financial statements are prepared well, so the numbers give a true and fair view of the company. But for internal auditing, in general, is not legally required. And in United Kingdom, there is a UK Corporate Governance Code, and it recommends that if a listed company does not have an internal audit department, it should annually assess the need for one. So it's a recommendation by the government for any listed company to have an internal audit department, but it is not a legal requirement. So it is not a compliance issue if a company or even a listed company it doesn't have any internal audit department. So they are different in terms of legal basis. And the third is about scope of work. For internal auditing, as said, it is established by the management team. So the scope of work is determined by the management team as well, and the coverage should be cover all areas of the organization, operational as well as financial. So here is one of the key for internal auditing in scope of work. It's not only about the financial. It covers both operational and financials. Therefore, for internal auditing, a lot of testing, a lot of works are covering on operation departments. It's not just on finance. But for external auditing, the scope of work is determined by the auditor, and the basis to perform the work by the external auditor is from the international standards of audit or international standards of auditing and any company law. So it is required by the compliance or compliance departments in the government to have the external audit for every listed company and public company, and they set the standards in the ISA, International Standards of Auditing, and the external auditor follow the guidelines, rules, and standards to perform their audit and to carry out the job. So it is the statutory duty to report any issues found, and it's mainly for financial focus because, as said, external auditor, they need to give an opinion on the financial statements, whether the financial statements can give a true and fair view. So it's financial focus. The fourth aspect in the difference between internal and external audit is approach. For internal auditing, it assesses risk, evaluates systems of controls. So here again, put the focus on systems of controls, and it tests operations of systems, make recommendations for improvements. In other words, internal auditing is not just a cost center, it is also a great department in order to provide or to recommend any improvement areas for the organization. And it can say, for example, improve the overall efficiency. That means there's cost savings from internal audit. For external auditing, it tests underlying transactions that form the basis of the financial statements. So it's a bit different between external and internal auditing in this approach. For external auditing, their focus is on the financial statements. So they just check for the transactions of the company to see whether they can support the numbers presented in the financial statements. But for internal auditing, it's more on systems of controls. They propose any changes or improvements in the operations of the systems. And for responsibility, which is our the last aspect to share with you on the difference between internal and external audit. For internal auditing, it is to advise and make recommendations on internal control and corporate governance. That means internal auditing is a partner with the board of directors to make sure the company have a good internal control systems as well as to comply with the corporate governance code, for example. But for external auditing, as described before, on the role, external auditing is to form an opinion on whether the financial statements give a true and fair view. So here are 5 different aspects for the internal auditing and external auditing. So let's look at internal auditing now. Internal auditing, it is a properly functioning internal audit department which is part of good corporate governance as recognized by all national and international corporate governance codes. So for internal auditing, even though it is not legally required, it is recognized by all national and international corporate governance codes that a company with an internal audit department is better than those companies without it. An internal audit has a particular interest in evaluating the company's risk management structures. So here is the interest of internal audit, which is to evaluate the company's risk management structures. So what can internal audit department or what can internal audit do? There are 3 tasks or 3 key areas that the internal audit can do. First, internal audit can manage the basic data used by management to identify risk. So as said, it's about a system of controls. It's about whether they can improve the overall operations. So first of all, internal audit can manage the basic data, and the purpose to manage the basic data used by management is to identify risk. So they can propose or they can recommend any changes or any improvements they highlight after reading through those basic data in order to minimize the risk. And next, internal audit can identify techniques for prioritizing and managing risk. So internal audit department should have the ability or should be capable to prioritize on which areas or which risk should be solved or should be minimized first, because their purpose is to minimize the risk or to manage the risk. So they should be able to identify any techniques for managing risk based on the data they collect. And thirdly, internal audit can report on the effectiveness of risk management solutions. For example, we have the internal controls. we have, say, purchase cycle. For example, we have different steps in the purchase cycle or the purchase system that we described before. So for internal audit, they should be able to manage the basic data collected through the purchase cycle and report and identify risk first, and then report on whether the effectiveness of these risk management solutions, that is the purchase system or the purchase controls. So where there is an internal audit function, the board should annually review its scope of work, authority, and resources. Described, there's a management. So the management in the board of directors, that means the board should annually review the internal auditor's scope of work, what area should be covered, for example, and authority of the internal audit department, as well as how much of the resource or how many of the resources can be provided for internal audit. As described in the 5 aspects, scope, one of the difference between internal audit and external audit is about the scope or the scope of work. So here, let's go deeply on scope of internal audit. First, reviewing internal controls and financial reports. Next, reviewing risk management systems. And then carrying out special assignments. And another scope is conducting operational reviews. So here are 4 different scopes of work by the internal audit department or by internal audit. We call the purpose of internal audit is to make sure the system of controls are monitored in order for the operation efficiency can be achieved. So here, like reviewing internal controls and financial reports is the first step for internal audit to collect basic data to understand about what is the situations right now, and next is to identify the risk. So reviewing risk management systems. For any good control, internal control, there should be the control can prevent risk, and also detection any risk or frauds, for example, errors. And last but not the least, the final step is to propose a solution or any solution to the error and frauds, that is the risk. So here the internal audit, they can review risk management systems in order to say, for example, if there's anything identified or any special thing, like here, fraud. If anything stolen, for example, if within the company, then the internal audit department should carry out special assignments to investigate why it happens and how to solve it. They can recommend any solutions to the organization, that is to the board of directors, in order to minimize the risk. If there's no fraud, for example, no fraud need to be investigated, they need to conduct a regular operational review as well. That is to improve the overall efficiency of the business. We share a lot about the functions of internal audit, what areas that it cover, and the scope of job as well, but there's some limitations for internal audit. First, about independence. Internal auditors sometimes are challenged of independence because some unavoidable independence problem. As said, internal auditors are appointed, or they are also the employee or staff of the company. So they need to report to the management as well. And it is an independent issue if they are within the organization, because they, for example, they have their the salary paid by the management team or approved by the management team, and any promotion, any salary increment should be approved by management team as well. But if they find any fraud, any other issues, it's quite hard for them to report directly to the board of directors or to the management. So it is first problem of internal audit or limitations of it. So some companies would like to hire external accountants or external body to perform internal audit job. It's not necessary for internal auditors should be the staff or employee within the organization. They can be hired from any external party as well, or external consultant to perform the internal audit job. It's the one way to solve it. And the next limitations is internal audit will only succeed if it is properly staffed and resourced. It's true. For many organizations, they would like to to do cost saving. So maybe first department to downsize is internal audit because they think it is a cost center. They cannot have any value added to the organization. So another limitation is the internal audit department is very tight in terms of resources. They are not properly staffed. And if internal auditors identify fraud, they may be unwilling to disclose it for fear of the repercussions. So here is the same as what we discussed in independence problem, because if there's any fraud identified, it's not good for them to disclose it because maybe fear or maybe any management team members, they are not happy because the root cause of fraud may be not just on the staff level. So independence is the first problem or limitations that we shared, and how can we minimize the problem or independence problem? Say, for example, the company can consider whether they can hire any external consultant to do the internal audit job. And another way is to form an audit committee. Okay, when we discussed about the committee, we share with you about the audit committee. An audit committee, the composition of audit committee members are mainly from the independent non-executive directors. So because they are independent, so the role of audit committee can help to reduce this limitation in different ways. First, it sets the work agenda for internal audit. From an audit committee point of view, because the members are mainly from independent non-executive directors, it's fair for them to set the work agenda for internal audit so they can understand what should be focused, what should be prioritized. And the audit committee receives internal audit reports directly. So the internal auditor, they just pass through their reports to audit committee, and without go through the management team members or even other executive directors in the board of directors. And thirdly, it is able to ensure the internal audit is properly resourced. So as said, one of the limitations is about the staffing, about the resources in internal audit department. So the audit committee can justify whether the resources are properly in the audit department or not. If not, they can propose in the board of directors to make sure the resource is adequate for internal audit to perform their task or job. And also important is because the audit committee, the composition is mainly from the independent non-executive directors, so they have a voice at the main board level. So now let's move on to discuss about external auditing. The key objective of external auditing or external audit is to report their opinion, again, it's opinion, on whether the financial statements give a true and fair view. and in accordance with what? With respective to standards and framework. So here are some key highlights for the objective of external auditing. As said, it is an independent examination of financial statements to ensure the opinion given is true and fair. And the independent examination is based on the accounting standards, audit standards, and any company law in the respective country. So once an external auditor external auditor goes through the financial statements and published with unqualified opinion. So here is one jargon or one terminology that you have to remember is unqualified opinion. Given you would like to proceed the study of accounting qualifications, in auditing paper, the unqualified opinion is the word that you always see in the textbook or in examination. So what does it mean, therefore, unqualified opinion? It means that a reported opinion that the financial statements do give a true and fair view. And here we highlight the external audit is to make sure the financial statements give a true and fair view. We seldom talk about give a accurate view or accurate numbers, because for external auditor, they have the scope of work. They cannot perform an investigation on every transactions. So based on external auditor, they can only give a true and fair view on the financial statements. It's according to the auditing board or any auditing organizations or associations. It is a common understanding of the external auditor to give the opinion just to provide a true and fair view. So after the audit, the financial statements will be more reliable in the eyes of readers of the statement. So it means the numbers are more reliable, but it doesn't mean that the numbers are 100% accurate. So it's not a guarantee the numbers are 100% accurate, even if the financial statements are audited by the external auditor. And as is required by law, as we mentioned, the external audit is not avoidable to many business organizations. So here, I would like to share with you the advantages and disadvantages of external audit to business organizations. For advantages, first, disputes. Disputes between management may be more easily settled. So what does that mean? It means in some cases, for example, the partnership business is quite complicated in terms of profit sharing. And if the company hired an independent auditor or independent examination on those accounts, it can help to minimize the disputes between management in the profit sharing for the business, because the auditor is an independent body to verify or to investigate about the numbers. And next, another advantage is the applications to third parties for finance may be enhanced by audit accounts. In many countries, for many financial institutions or banks, one of the requirements for a borrower to have a loan is to provide the audited accounts. It's the basic requirement, but it doesn't mean that when you provide the audit accounts, then you will be a loan will be granted by the bank to you. It is only one of the requirements, because the bank would like to look at your numbers in the past, and the bank also look at your financial forecasts or projections of your business, because the bank prefer to have a stable cash flow for the repayment of their loan and interest in the future. So the bank is preferred to look at the future, but The bank also needs a ground or foundation to see whether your projection is reasonable. If it's not reasonable, say in last year you are making just 1 million profit and you project to have 30 million profit in next year, the changes is quite significant. So the bank will be a bit concerned to see whether your projection is accurate or not, or not accurate, maybe the projection is reasonable or not, by refer to what the audited accounts in previous years. So it's very it's a common practice for the bank to lend money to any business organizations. And thirdly, the audit is likely to involve an in-depth examination of business and so may enable the auditor to give a more constructive advice to management. And fourth, major changes in ownership may be facilitated if past accounts contain an unqualified audit report. For a lot of merger and acquisition transactions, that is the M&A transactions, because they involve the changes of ownership, the buyer of the company, say for example, they would like to take a look or have an investigation of the target company financial statements, like 3 years financial statements, because they would like to go deep to see any unqualified opinion provided by the auditors first of all, and because the numbers can provide a true and fair view of the company status. So the buyer of the company can also review what's the reasonableness of the business in terms of financial numbers. And disadvantages. First of all, you need to pay. It's about the fee. You have to pay to the auditor, the services provided by them. So it's not good to many organizations to have extra or to have any additional cost. And next, the audit involves the client, staff, and management in giving time by providing information to the auditor. That means your finance department or account department, their staff is not just they are not just working on their routine job like to do the month-end closing or any account reconciliations, but they need to provide the information to auditor and to answer their questions. So they need to spend extra time to do it, as well as the management team members. They have to deal with, or they have to talk to the auditors to explain the transactions, for example, because sometimes the staff, they don't know the details and they would like to go through or go deeply. The auditor, the external auditor, need to talk directly to the management team. So now let's move on to internal control and audit. So let's see what are the relationships between internal control and audit. First, I would like to give you one question here. Why internal control interests the external auditor? So, in other words, why external auditor would like to see the internal control? So, why the external auditor concerned about it? The principal reason why internal control interests the external auditor is that for internal controls, if it is more reliable, it will reduce the amount of substantive testing of transactions and resultant balances in the ledger accounts required. So here is about whether the external auditors need to perform extra work or perform a lot of work for provide or give a true and fair view of the financial statements. If the internal controls are reliable, that means they no need to go through a lot of substantive testing. Substantive testings are tests for accuracy, and they are used to set up facts or establish facts. So in other words, they need external auditor no need to do a lot of substantive testing if they can rely on the internal controls. It doesn't mean that they no need to do any jobs or works, but it can help for them to minimize some of substantive testings of transactions. And there are two reasons that external auditor needs to consider the adequacy of sound accounting system of internal control. First, if the accounting system of internal control is great, it helps to reduce risk of error in the accounting records. Next, external auditor has a statutory responsibility to form an opinion. For first, reduced risk. If it is very important to the auditor to set up what system of internal control exists and then to test that system to find out whether it is working properly. So in other words, if they found the system is good, the risk of error here can be reduced in the accounting records. Because they need to check whether the internal control system is working or is functioning properly. So here, if yes, then the risk of error will be reduced. So it's just a direct relationship. And for external auditor, here, it implies the operation of a sound system of internal control if the internal control system is good enough. So here is another question. We just share with you why internal audit interests the external auditor. So next question is why internal control interests the internal auditor. An objective and adequately resourced internal audit function should be in a position to provide the board with much of the assurance it requires regarding the effectiveness of the system of internal control. It's the purpose of internal audit because they are appointed or they are hired by the company to provide the recommendations to the board, how to improve the operational efficiency as well as how to ensure the operations is effective with the internal control in place. And internal controls are fundamental to the work of internal auditor. So internal auditor, they are interested about internal control because internal audit, as said, the objective is need to report to the board to ensure the systems is proper, but the systems should be with internal controls. If no internal controls, that means internal auditor cannot effectively to monitor the overall system and to manage the risk that is assigned by the board. And internal auditors have to make decisions on the extent of reliance on controls to manage risk and therefore the level of testing to be carried out. If there's a good internal control, it also means that internal auditors can do less instead of more, can do less tasks or less testing on the overall control system. So in the past, internal audit staff were seen as business prevention because they were seen as adding additional unnecessary controls. Is it true? Yes and no. But we need to think internal auditors need to be adding value. Here is the key word here. Internal audit need to be adding values, and therefore we review the cost effectiveness as well as the adequacy of controls. So here is the key points for internal audit. first of all, they need to review the internal control systems. And if there's a sound internal control system, then internal auditor can minimize their testing, which is in the same logic as we described before for the relationship between internal auditor and external auditor. So here is more or less the same logic. If there's a good internal control, the internal auditor, they can spend less time on testing and they can do another task, or the whole internal audit department. The department size can be a small, no need to be a big department. And for some organizations, they set up the internal audit department, but also they will set up internal control department as well. The rationale behind is, as said here, if they have a good internal or sound internal controls, it helps to minimize the task performed by internal auditor as well as the external auditor. So the overall spending on internal audit and external audit can be minimized with a good internal control system. So last topic here is talking about how to ensure the effectiveness of internal financial procedures. Effectiveness is a measure of the extent to which organizational objectives are being achieved. So to see whether the organizational objectives are achieved, then how much of the resources that we use to achieve is about the effectiveness. For internal financial procedures and for management, they have to ensure first is all the orderly and efficient conduct of the business exists. So it's one of the key on internal financial procedures for management to ensure. And next, safeguarding of assets. For sure, the internal financial procedures must ensure the assets are safeguarded, and the prevention of detection of fraud and error. That means the systems can prevent any or detect any fraud and error, and also the accuracy and completeness of the accounting records, the timely preparation of reliable financial information. So for all 5 points, or for all 5 key areas here, the management has to ensure them are properly in place in the company to have a good internal financial procedures. And the best way for management to set about achieving these objectives will be to implement all 5 components of internal control in the financial reporting function. So I will summarize the discussion in chapter 14 with this chart. About internal control, yes, there's 5 key components. First, good control environments. Second, regular risk assessment process. Third, good information system and communication. 4, appropriate control activities. And 5, monitoring of controls. So here are 5 key internal control components. And with good corporate governance, we have the board level, we have the employees level, we have the external auditor, internal auditor as well. So how to ensure the effectiveness of internal financial procedures? Okay, the management ensure like the orderly and efficient of conduct of business, assets is safeguard, prevention and detection of fraud and errors, accuracy and completeness of financial numbers on our accounting records, and also the timely preparation of reliable financial information. And here the best way is to have both corporate governance in place, internal control in place as well. So question, there are 3 in-class questions for you here. First, the internal audit. The statement here, the internal audit is simply a necessary cost that must be incurred by a company and offers few intangible benefits for the organization. Is this statement true or false? Okay, remember, internal auditing is set up by the management team to examine and evaluate the organization's risk management processes and systems of control, and to make recommendations for achievement of company objectives. So, do you think whether they are only the necessary costs with very few tangible benefits? Next question is an open-end question. Why might a bank insist on an external audit of a company's accounts before lending money to the company? Let's recap about external auditing. It is an independent examination of the evidence from which the financial statements are derived, in order to give the reader of those statements confidence as to the truth and fairness of the state of affairs which they disclose. So based on what we describe here, so why the bank insists? Because confidence. The statements, confidence, true and fairness, okay, and state of affairs. So to make it simple is, with audit reports, the bankers are confident about the state of the affairs of the company or the organization. So here, another in-class question. The statement here, internal audit may be carried out by employees of the company being audited, or may be carried out by external accountants who are paid for delivering this service. Whether this statement is true or false. We discussed about the scope of internal audit here, and we also share with you whether the internal audit can be carried out by internal staff or can be carried out by both internal and external internal staff and external consultant. So I think after this class you can answer this question by choosing true or false. One more, a bonus question in class. The reporting of internal control weaknesses to management is the primary objective of external audit. Is it true or false? Remember, here, independent examination of financial statements. So whether you think external audit is interested in any internal control weaknesses and reports to the management on this, is it the primary objective?